All right, thank you so much for joining me in this video lecture. This is going to be the next lecture in the series for financial management video lectures. So we have talked about much of the financial management till now. So we have covered a lot, like we have talked about the basics, after that capital structure, cost of capital, leverages, then sources of finance, then capital budgeting, and much more. So in this video lecture, we are going to talk about the next portion of financial management, and that is going to be regarding working capital management. As I have already given you examples so many times that financial management is all concerned about your financial planning, like where you have to get funds from and where you should invest these. So business is always at a central point. Okay, from one side, we can say from the left hand side, here are the investors from whom you get the money, like they can be your equity shareholders, they can be your debentures, and when you receive the money you have to employ these funds. Okay, so you can employ these funds to investment best opportunities or profitable opportunities. So these are basically two kinds of avenues in which you invest. Okay, so the first avenue in which you invest are known as fixed cost assets, for which there is a separate chapter, and that is named as capital budgeting. And the second one is employment of your raised funds into working capital. For that, this is the next topic. This is working capital management, for which we are going to talk about in this video lecture specifically. So what should be the structure of that? First of all, we shall be talking about working capital, then its management, its sources, and most importantly, how much working capital is required in the business. And when we talk about how much working capital is required, then obviously there are some techniques or methods to find the optimum balance or level of working capital. Because if you have excessive level of working capital in your business, then it do not produce much money for you. It's not profitable for you. But in case you are having the lesser working capital than required, then you shall be in shortage of funds. You shall not be able to meet your short-term liabilities or obligations. Then what should be the proper trade-off? The proper trade-off should be to have the optimal balance of working capital, so that there is neither the shortage nor the excess of working capital. So in this video lecture, I shall be talking about what is the optimal level of working capital and how you can achieve that. What are the different methods and techniques on the basis of which you can find the trade-off between the optimal level of working capital required, that this is neither the shortage nor the excessive balance. And finally, we shall be talking about the strategies for use of working capital. And lastly, we shall be talking about some of the important Indian committees which have recommended something regarding working capital matter. So this is all the structure of this video lecture. I hope you would enjoy that. Just going to share the screen with you all. See that and clear your concepts. All right, so I hope you would be watching the screen right now, and it's written the topic name. This is working capital management, and we have already given you all the related details regarding that. This is working capital management. So we shall be talking about that. I hope in the beginning of this video you have already got the structure and idea what is there for us. So taking a very short and very simple example, this is your business, maybe this is you. Okay, so first of all, you get the sources of a finance. From them you get the money which is to be invested into your business. Okay, and that money is used in two forms. Okay, first of all, you try to purchase fixed cost assets, which are machinery, plant, or other investment things. Okay, these things are covered under the capital budgeting decisions, and some of part of the money raised is used as your working capital because you need the working capital or current assets or cash, these kind of things, for meeting your short-term obligations, and that is to be covered under the broader part of working capital management. This is why we have to study this specific chapter, and in details we are going to talk about this. So if you have understand this example and the example given by me in the beginning of this lecture, then understanding this chapter is very easy for you. So what we have to do, we have to understand first of all the meaning of working capital. Working capital is simply the money available to the company for a day-to-day operations. Okay. So for daily operations, you need money because maybe you have to pay some immediate bills, you have to receive money from somewhere else. Okay. So like for day-to-day operations, you need money, and that money is the do form the part of working capital. So what does it includes? It basically includes the cash, then inventory, then accounts receivable. These are bills receivable, then accounts payable, these are your creditors, the portion of debt due within 1 year, another short-term accounts, company's working capital. So we can say company's working capital reflects the result of a host company's activities, including inventory management, data management, revenue collection, and payment to suppliers. So decisions and management regarding all these short-term sources of funds or application of funds is known as working capital decisions or working capital management. So what do we mean by working capital? So the concept of working capital can be divided into two parts. The first can be considered to be the gross working capital. So what does that working capital mean? So gross working capital is always your total of current assets, and current assets are involved. These current assets involve so many things like your cash, your bank, your sundry debtors, your bills receivable, your short-term securities, and all the related things to that. Okay, if you make sum of all these items, that sums up to be your total asset, and that is also known as your gross working capital. And the second concept is the concept of net working capital. So what does that mean? When you subtract the value of current liabilities from your current assets, so that comes out to be net working capital. So current assets, you have got the idea regarding cash, bank, marketable securities, bills receivable, then your sundry debtors and short-term inventory and these kind of things. And as far as current liabilities are concerned, these are creditors, your bills payable, your trade payables, short-term like bank overdrafts, these kind of things are your current liabilities. So when you subtract the total of your current liabilities from your current assets, the balancing figures that comes out to be, that becomes your net working capital. And it is always desirable to have the ratio of 2:1 for current assets and current liabilities. This is always desirable from the point of view of optimum level or soundness of working capital. So net working capital is an accounting concept which represents the excess of current assets over current liabilities. So this is all about that. I hope you would have understood this. Now I'm just going to move further. It's not that the working capital can be bifurcated only in gross and the net working capital. The working capital can broadly be taken into account from other points of view as well. The first is permanent working capital and the second is variable working capital. So what do we mean by this all? So a part of investment in current asset is permanent as the investment in fixed asset. Some part or some money which you have received from your investors, this is always blocked. This is always available for working capital, and you do not try to pull out the funds from these. Okay, so this is known as your permanent or fixed working capital. So what do we mean by that? So the permanent or fixed working capital is basically of two kinds. This is the capital which is always available at the disposal of the company. So this is of two kinds. The first is a regular working capital and reserve margin or cushion working capital. So regular working capital is that amount of liquid capital required to keep circulation of capital from cash to inventories and receivable and back again to cash. You know that first of all you have the cash, and after that you purchase inventories from that. After that you make the finished goods, and these are sold, and cash is then bills receivable or sundry debtors are there, and when they pay you cash. So this is the complete circulation of how the cash is generated. For making this circulation at pace or at regular basis, you need the kind of funds, and this is known as regular working capital. And after that there are some reserve margin or cushion working capital. Sometime you have to take into account some extra capital required to meet some unforeseen contingency which may arise in the future. So this is known as a reserve margin or cushion working capital. Then what does variable capital mean? This is different from permanent working capital. So variable capital simply means when you don't need to require the permanent or the fixed blocked working capital. So it can be it can vary on the basis of volume of a business. If business volume or sales turnover is large, then maybe you need the more working capital, and in case the sale or turnover is smaller, then you may need the lesser working capital. And this variable working capital can further be divided into two parts. The first is a seasonal working capital, and the second one is special working capital. In case of a seasonal, this is the liquid capital which is needed only during some particular seasons, like seasons of festival, whenever you have to make immediate payments or some regular payments. Then special working capital, this is for special operations of the organization. For example, the immediate advertisement or special campaigns for increasing the sales of your business. So this is all about that. Okay. So I hope you have understood this. So till now we have talked about working capital. What do we mean by that? Then gross working capital, then net working capital, permanent working capital, and temporary or variable working capital. So how much should be the level of working capital in your business? So this is the important thing. This is the most important criteria which you have to decide, because I'm just going to give a very important example here, on the basis of which you shall be able to comprehend why this concept is really worthy of a study. So you know that you are having your business, you have raised your fund from different sources, like these can be your equity share capital, and these can be debenture. Whatever the amount you have raised, you have made some capital budgeting decision and working capital decision. So whatever the money is blocked in working capital, it do not generate any kind of revenue for you. Okay, so this is you have to understand, because whatever the cash is lying in your bank account, you have not invested in anywhere else. So this is why it is not going to generate any kind of return for you. So it is always desirable to not keep more and much higher level of working capital in your business, because if you are having the higher working capital, then it's not generating any kind of revenue for you. So there are three basic levels. Okay, so the first level is working optimal level of working capital, and if your working capital is increasing from the optimal level, then you are losing the money, you are not generating any kind of wealth. And if your working capital is lesser than the required working capital, then what happens? Then maybe you sometime you don't have the sufficient funds to pay your immediate liabilities. So it is always desirable to have optimum level of working capital, And for that there are different theories which tells you how you can calculate the optimal level of working capital. But before understanding these theories, we have to understand what are the different reasons which tells you that working capital should be there. What are the different reasons? And these reasons are the determinants of working capital, which tells you that how much and uh, why should you keep working capital with you. So the first point is nature of a business. If your business is highly liquid, okay, like this is a seasonal, then obviously you need working capital. Then for production policies, you need working capital. Maybe you have to purchase immediate raw material on a regular basis. Then for manufacturing process as well, you need money time to time on regular basis. So this is why the working capital is required. Then turnover of circulating capital. Circulating capital means the capital which is revolving. Okay. Same example I have given you. First of all, you have cash, you have then inventories, do you have sales, you have bill receivable. So on the basis of that, you can get to know, you can calculate that if your turnover is huge, you may be requiring the higher level of working capital. Then obviously for growth and expansion as well, sometimes you get the immediate opportunities to invest, so you need some immediate funds. Then business cycle fluctuations are there. Sometimes there is the period of boom, there is a period of recession or depression. These kind of things are there. At the time of these kind of exigencies, you need some kind of reserve funds, and these are met through working capital. Then terms of purchase and sale, sometimes your creditors do not allow you for making the credit purchases, then you need the immediate money. For this reason also you need the working capital. And finally, for the purpose of dividend policies, sometimes your shareholders, equity shareholders, require the dividend payment to be made. And in that case also, you need to make a payment to them. And this is made out of the immediate holding. So this is also one of the reason why working capital is required. So now, as you have got to know that what are the different reasons for having the optimal level of working capital, then you must be thinking that how you should calculate the optimal level of working capital required. Okay, because there is always an optimal level. If your working capital is increasing, from that you are not generating any kind of return, you are losing money. And if the working capital is lesser from the optimal level, again then you may be having some kind of problems, because maybe you don't have sufficient fund at the time of making the immediate payments. So having the level more than or lesser than the optimal level is always dangerous from the point of view of any organization. So this is why there shall always be an optimal or best levels for the working capital. And how to calculate this? There are 5 famous methods which tells you that what should be the optimal level of your working capital. So one by one, we shall be talking about all the required and all the given methods of estimation of the proper working capital required. The first is percentage of sale method. This method is very simple. Okay. So on the basis of your past experience, on the basis of your sales volume, on the basis of your sales volume and previous level of working capital, you can easily calculate how much working capital is required in your business. Okay. So how we do that? You know that if the sales for 2000 were 30 lakh and the working capital required was 6 lakh, then you can first of all find its percentage. Okay, this is working capital divided by sales. So this is working capital divided by sale, and when you find its a percentage, and that comes out to be 20%. That means the past experience of your company shows that you need 20% working capital for smoothly running of your business. Then what you do, whatever the sales are expected in this year, suppose the expected sales are 40 lakh, you just multiply this with the actual figure of a percentage of working capital which you have calculated earlier. And when you multiply sale by the um, expected percentage of required working capital, then you can easily calculate the working capital required in the current year. So this is how you calculate the requirement of working capital on the basis of percentage of sales method. So this method of estimating working capital requirement is based on the assumption that the level of working capital for any firm is directly related to its sale value. So here a relationship between two items is seen. Basically, this is the working capital and sales of the company, and you can get to know that on the basis of sales, you can easily calculate the working capital required for upcoming years. So this was the first method. The next is very important and very, we can say, very logical method. This is known as a regression analysis method or average relationship between sales and working capital. So here again, the relationship between the sales and working capital is seen, but this is not seen on the basis of a specific proportion or percentage, but this is seen on the basis of regression analysis. Okay, here the regression analysis is done, and on the basis of a past experience for so many years, you can calculate what shall be the required level of working capital in the current year or upcoming years. So this is just an equation of that. Here the variable y stands for the working capital, and this is the dependent variable, and this is the intercept. This is intercept of the equation, and this beta is the slope. So this is intercept and this is the slope, and this is the value of your sales, this, and this is an independent variable. So I hope you have the basic knowledge regarding regression. If you ask me right now, I'm going to give you that. So what do we mean by that? The independent variable is always written on the OX axis, and the dependent variable is always written on the OY axis, and this is the working capital. So intercept is the initial point where the actual geometrical line starts. So suppose it starts there, starts from here, and slope estimate the curveness of the line. Okay, so this is the slope. So this line tells you that what should be the required amount for working capital. It can be for many years, like for 2006, 7, 8, 9, 10, 11. On the basis of a sale, you can calculate what should be the required amount for the next period. Okay, so these are the two parameters of the regression equation, and the final one is the independent variable, and this is the value of a dependent variable. By solving this equation, you can get to know what should be the value of your working capital. And but you should not be worried much about that, because of the reason that the question is not going to ask you any kind of a practical, but you must have the basic knowledge of how regression works. So this is all about that. So if I'm reading the theoretical portion of that, it tells you that this method of forecasting working capital requirement is based upon statistical technique of estimating or predicting the unknown value of a dependent variable from the known value of independent variable. So we know the known value of independent variable are sales, and on the basis of that, unknown values of working capital can easily be find out by estimation of the parameters of the regression analysis equation. So now what we have to do, so this is the next method. This is method number third for estimation of the optimal level of working capital required in your business. So how you can calculate these? So this is known as a cash forecasting method. This is very easy. Okay. How you know that for day-to-day operations on the basis of your past experience, you know that there are some regular cash receipts and there are some regular cash payments. These are known as cash disbursements. Okay, so you need the basically you need money for these for regular operations. Okay, so first of all you need the money for cash receipts and for payment, or these are cash disbursement. Cash receipts can be on the basis of bill receivables and sundry debtors and like these. Okay, so like these avenues there can be your cash receipt, and cash disbursement can basically be uh, from uh, from sundry creditors, or this can be from the bills payable or your bank overdrafts. These can be your payment required. So what do you have to do? You have to just prepare a list of all the cash receipts and all the cash disbursements, and on the basis of that list, whatever the final balancing figure is there, you can easily calculate that how much working capital is required in your business. So this is known as cash forecasting method. So what you actually do, this method of estimating working capital requirement involves forecasting of cash receipt and disbursements during a future period of time. So you just calculate or forecast whatever the cash receipts are going to be there and whatever your cash disbursements are going to be there in the upcoming year. So this is all about that. I hope you have got idea, and that was the very important third method of uh, calculation of the exact working capital requirements. The next method is operating cycle method. So this method is the most important one. Okay, so from all the previous method, whether this is the percentage of sale method, then this is a regression analysis method, or cash disbursement or cash requirement methods, the most important method is the operating cycle method. And for understanding this, you have to you have to know uh, the meaning of operating cycles first of all. Only then you can easily able to understand the concept of uh, the operating cycle method. What do we mean by operating cycle? First of all, the operating cycle is the cycle which tells you that how fastly in a in-house speedy manner you can get your money back. Get your money back means cash, because if you have a manufacturing concern, first of all you have the cash and you purchase some kind of raw materials. Okay, after purchasing you just involve in your production operations, and from production operations you prepare the finished goods, and after these finished goods the sales are made. After sales are made, the sundry debtors are generated. After sundry debtors are generated, bill receivables are generated, and after that cash is converted. Okay, so this is known as the proper operating cycle, which tells you that how fast the cash can be generated. So if the period between all these things, if the period between all these things is lesser, like if you are very fast in this circulation, then obviously you need less working capital, and if you are not that fast, then you need more working capital. We shall be talking about this in detail while studying the operating cycle method, but this example has been taken only considering into account the different current assets, but current liabilities are also there. Like for purchasing the raw materials, maybe you get some kind of a credit, so the role of a creditor is always there for operating cycle as well. So now I'm going to teach you regarding operating cycle method, and I shall tell you how the time and money required for different elements of operating cycle is calculated. Okay, again listen me, how the time and money required for different elements of operating cycle. So what are these elements? These elements I have already explained you, like cash, inventories, bill receivable, sales, finished goods, these kind of things. So this method of estimating working capital requirement is based on operating cycle concept of working capital. The requirements of working capital be estimated as follow. The proper computation of working capital under this method, a detailed analysis made of each individual component of working capital. So you have to make the detailed analysis of that. And when you have made that, the value of each individual item of a current asset and current liability is determined on the basis of estimated sales or budget production or activity levels. And this is as follow. One by one, we shall be talking about all. First of all, you have to find the value of a stock of raw material, and this is found on the basis of the below given formula. You don't need to be worried about practicals are not there, but you must know how you can find the optimal level or the optimum cash balance or level of different items in current assets and current liabilities. So the first one is stock of raw material, and this is calculated as below. So it takes into account budgeted annual units of production. Like suppose you have generated this is the 5,000 units you are planning. Then this is estimated cost of raw material per unit. Suppose this is 5 rupees. Then average raw material holding period in a days, months, or weeks. Suppose this is 60 days. Okay, divided by number of days, month, weeks in a year. This is 365. When you calculate this equation, you can get the value of the stock of raw material required in your business. So this is the first element of the operating cycle method. And the second one is the value of stock of work in progress, and this is all same as what we have already gone through regarding the previous one. Okay, so what do we mean by this? So stock of working capital in progress can also be calculated in this way. First of all, you have to write budgeted annual unit of production. Suppose these are 5,000 units, and after that you have to calculate the estimated work in progress cost per unit. This is 6 rupees. Then average work in progress holding period for days in months. Suppose these are 50 days, divided by total number of days, months, week in a year. These are 365. And when you calculate this equation, you can get the value of stock of work in progress. So I hope you have got the idea that in this way, the each and individual element of the working capital can be find out. So in this way, you can move further. So this was the second one, and third is the value of a stock of a finished goods. And how to calculate that? Again, we have to apply same kind of formula. First of all, there is budgeted annual units of a production. Suppose these are 5,000 units. And after that, estimated cost of a production per unit. Suppose this is a 7 rupee per unit. Then average holding period of a finished goods in days, months, or weeks. Suppose uh, these are 4 weeks. Okay, number of days, number of months, weeks. So if we have taken in the numerator the weeks, in the denominator also we have to take weeks. Okay, so these are 52. When you solve this equation, you can get the actual value of stock of finished goods required in your company. And this is how you calculate all the things. And I hope that is interesting and that is very logical concept for you. The next one is cash and bank balance. So this is just one of the current asset of a business. It is needed all the time because you have to keep business going. Business firm has always to ask, and you can take the optimum cash and bank balance on the basis of established theories for this specific thing, and on the basis of your previous experience as well. Then this is prepaid expenses. Sometime you make the payment of wages, manufacturing overhead, office and administration expenses, um, in a very, we can say, advanced manner. Okay, so you make the payment to all these we can say elements in a very advanced manner. So these are also taken into account for calculation of the operating cycle period. Okay, so these also do form the part of uh, our working capital management. The next one are trade creditors. This do form the part of our current liabilities. What do we mean by these? These are those person from which we can purchase the raw materials or consumable or stores on basis of a credit, and their value should also be calculated, because working capital is the subtraction of current assets and current liabilities. So as we have calculated the individual value of all the current assets, in the same way you have to calculate the individual values of all the current liabilities as well. So first of all, trade creditors are there. How their value shall be calculated? This is the formula. So this is the budgeting annual units of production. Again, suppose these are 5,000 units, then estimated raw material cost per unit, suppose this is 6 rupees per unit, multiplied by average payment period of a creditor in days, months or weeks. Suppose this is 3 months, then these should be divided by total number of months in a year. These are 12 months. Okay, so when you solve this equation, you can get the value of the trade creditors for the current period of your company. Then the next one is creditors for wages and other expenses. These are those persons like your labor or some other kind of things, and these are there. Okay, for them you have to make the payment. How you can calculate this? You can calculate on the basis of following formula. This is budgeted annual production in a unit. Again, I'm taking the example of 5,000 units. Then estimated labor or overhead cost per unit, this we suppose 1 rupee per unit. Average time lag in payment of wages, we assume it to be 30 days, and these should be divided by 360 days, and as we have to divide whole of the equation with the number of days, months or week in a year. When you calculate the value of this, we can easily obtain the value of creditors for wages and other payments expenses. So that should be the proper structure or performa for estimation of working capital requirements. Okay, so this formula is based on two things. Okay, so different kind of concerns or businesses are there, so they have to adopt different kind of performa. So this performa is for a trading concern, okay, which is having the trading concern, which do manufacture as well. So here, first of all, this is the list of current assets. So it is the calculated amount of all the figures on the basis of formulas, which I have already explained you previously. So this is the current liabilities. You have to make total of these, and working capital is just the subtraction of current liabilities from current assets. So this is all about that. So after that, you have to add some margin for contingencies, and this is the net working capital required. This is how you can calculate the total amount required for your working capital, and this performa is specifically for trading concerns only. So what's the performa for core manufacturing concern? Core manufacturing concern which have their factory premises as well. So in case of a factory premises, you have so many kind of stocks. So you have to take into account the different values of different kinds of stocks as well. So that's why their performa is different. So here is the performa. Current assets include stock of raw material, work in progress, further divided into three parts: stock of finished goods, raw material, labor, overheads, and what's not. So all these things are calculated on the basis of already defined formulas. And after that, see, in the similar manner, the calculation of current liabilities is made and you just subtract the value of current liabilities from current assets, and you find the value of working capital, and this is how all the things are done. Then you add the provision or margin for contingency, and the balancing figure is your answer. And this is the columnar formula, format or specimen, in which what you do, you just take into account the horizontal format of each and individual asset and liability. And when you do that, you can explain the complete requirement of working capital in a separate column. Now you can see that this is raw material, this is work in progress, this is finished goods, sundry debtor, cash and bank balance. So in this way, for each and individual item, you can just prepare the different tables, and the calculation is made finally by summing all the values up. So when you do that in this format also, sometime the calculation for the working capital requirement be made. And now this is, I think, the last method for calculation of working capital requirements. I have already taught you 4 things, okay? 4 major formulas. The first one was, we can say the first one was a percentage of a sales method. After that, I taught you regression method. After that, there was cash forecasting method. Then operating cycle method was there, and finally this is projected balance sheet method. And this is very simplest formula for finding the requirement of working capital. So what is that and what is done in this? This is very simple. In this, on the basis of your past experience, you just prepare the balance sheet for upcoming years. Okay, so you just make the projected balance sheets. Projected, like suppose this is 2022. Okay, okay, this is this financial year. Then you can prepare the balance sheet for 2023 as well, and that shall be projected or forecasted balance sheet. And on the basis of this balance sheet, you would have written current assets and current liabilities as well. So you just can find the value of working capital by subtracting the value of current liabilities from the current assets, so from this given projected balance sheet. So under this method, projected balance sheet for future date is prepared by forecasting asset and liabilities by following any of the method above. So this was the simplest method, and I hope everything is cleared to you right now. So we have studied a lot in this video lecture, but still we have to cover 2 or 3 major things. Like I have taught you till now what are the different techniques for finding the optimal balance of working capital. And now we have to find that how and where you should get money to be invested into working capital. Although I have already explained you that this is your business, you get the money from your investors, this is the sources of funds. You apply this money into 2 formats, the capital budgeting decision and working capital decision. So this is not the only source. Okay, so this is not the only source. There are some theories which suggest you that how and where you can get this money from, how the money to be invested into working capital requirement is to be obtained, where you can get this money from. There are different theories which have been defined on the basis of the proportion between your risk and a return. On the basis of the risk you are able to take, on the basis of the return you are willing to get from your business. So there are 3 working capital management strategies or approaches which choose the mix of long and short term funds for financing your net working capital decision. So these strategies are different because of their different trade off between risk and profitability. So this is the difference to the extent or proportion of application of long and short term funds, because you have both kinds of funds in your capital structure. There are long term funds, these are the equity capital, preferential capital, debentures, And there are short-term funds, which are sundry creditor, bills payable, bank overdraft, etc. You get the money from this and you apply this to working capital. So how much money from long term should be used and how much money from short term is to be used? So for answering this question, there are three different strategies or categories. The first is conservative strategies, the second is hedging strategy, the last one is the aggressive strategy. Okay, so on the basis of that, you can easily find what should be the optimal level or value of your working capital from the different sources of finance. So all these strategies I am going to explain you right now. The first strategy is hedging or maturity matching strategy. This strategy tells you that uh, this is meticulous strategy of financing the working capital with moderate risk and profitability. You can see that its line is in between. So this is taking moderate risk. Okay, neither the much risk uh, nor the much returns. Okay, so this is the balance between risk and profitability. In this strategy tells you that all your assets should be financed by debt instrument and almost of same maturity. So whatever the this is the balance sheet. Whatever the funds you are getting, so they have their period. Like debenture can be having period of 5 years. Preference share capital can have the period of 6 years or anything. Okay, so in this strategy, each of the asset would be financed by debt instrument of almost the same maturity. So you can purchase the assets from these funds, and these should be for the same level of maturity. Okay, so these should have at least that much lifespan, as the lifespan of these funds are there. And you can finance your working capital as well from these funds. So this is the first strategy which tells you that all the assets should be financed by the debt instrument of almost the same strategy, of the same maturity period. Then this is conservative strategy. As the name suggests, it is the strategy of financing working capital with low risk and low profitability. What does it tells you in this strategy? Apart from fixed asset, permanent current assets, part of a temporary working capital is also financed from long-term financing sources. So long-term financing sources are equity, there is preference, and there is the debentures. Okay, so whatever the money you get from these, you have to spend this into long-term assets. These are your machinery or your plants, and some portion of this should be dedicated to working capital requirement as well. So this fact expose you that you have to use these funds for financing your working capital as well. Okay, so the first one was telling you you can finance, but the level of financing should be the optimum level. Okay, you are not supposed to use um the higher proportion of long-term funds for financing your working capital. You should use the mixture of long-term as well as short-term sources of finance as well for financing your working capital decision. But this strategy or conservative strategy tells you that you should use your long-term funds for financing your working capital decision. And the last one is aggressive strategy. This is high risk strategy. It tells you that you should use more of short term finances, short term funds for financing your working capital decision. But this is the very risky strategy. So in this strategy, the dearer funds, long term funds, are utilized only to finance fixed asset and a part of working capital requirement. So it tells you that the long term funds should be used only for financing the fixed asset. So you can use some of the portion, but the higher portion of working capital should be financed through short term sources of finance only. So this is all about that. I hope you have got the idea. So now the only thing that remaining is the different kind of committees in India for managing the working capital requirement. Time to time, there had been some of the important committees which suggested something, and their suggestions you have to go through as usual, for which the PDF has already been submitted to you. So we have just written some names of important committees and the time when these were formed, and whatever their recommendations were obviously these were related to the management of working capital in the Indian industrial business. Okay, so I'm just going to take the names of all these. The very first was the Dehijia committee, and it was established under the chairmanship of Shri V.T. Dehijia in 1968. Then Tandon committee is there under the chairmanship of P.L. Tandon in July 1974. Then Chor committee, Shri K.B. Shore in 1979. Then Marathe committee under the chairmanship of Marathe in 1982. Then Chakravarti committee under the Sukhmoy Chakravarti in 1985. Then Kannan committee report under the chairmanship of Shri K. Kannan in 1997. So these have been some of the important committees. We have not written their recommendations specifically in these slides, but these have to be covered formally, because although their probability is low to be asked in the examination, but still for the safer side, I believe that you go through from whatever the things we provide to you. Already the notes have been delivered to you. So I hope you have got the idea regarding each and everything of working capital management. I have taught you a lot in this video lecture, and this was very important, very beautiful, and very interesting. I think you would have learned something new in that. So the next lecture should be now. If you have the complete idea regarding the financial management now, then you can easily expect the next lecture to be of dividend decisions. So after that, we shall be almost covering all of the financial management from our business point of exams point of view. Thank you so much for joining me. This is Gurpal Singh from Gursura Education.